So right now there's a lot of confusion and then also a lot of FUD as well. If you go on X or Twitter, you're going to see exactly what I mean. If we take a look right over here, this is the fear and greed index. Right now it's at an all-time low. It's at 20 right now, and earlier, back a week ago, it was about less than 10. If you look back into January to sort of April, the tariff Armageddon, Liberation Day, that huge drop, that's where it was. That's at its lowest right over here. And if you take a look at about a week and a half ago, you could see it was below 10. People were at its extreme fear. And then during this time, you could see that you have people like this who come out and sort of FUD their timeline, talking about Bitcoin going to 35, 40Ks. Now, I'm going to present some data that really will shed light on this issue, and it'll give you some information so that it can guide you to make informed decision. And this was one of the most useful data point that I saw. It's by Check on Chain by Checkmate. If you can see right over here on the x-axis, that's your Bitcoin price. Notice all this green right over here. The y-axis is the invested capital. About 28.8% or 30% of people who bought Bitcoin early. These are the early buyers. Some of the people who bought it 7, 8 years ago, 9 years ago, and their wallets haven't moved, or we call them zombie wallets. They're in profit. But once you hit this 86.5Ks, 71% of the invested capital is now at a loss. They're now underwater. So all of this red, so these are the recent buyers, the ETFs, the DATs, institutional buyers, retail that's been FOMOing, and whales that reposition themselves. So I want you to remember that below 86.5 thousand, they're actually in a loss. So going forward, when you use this data, I want you to have that mental map in your mind. Here's the other really useful data by Checkmate. You can see right over here, here's the black line, that's Bitcoin's price. The blue line, the light blue line, that's the true mean price. These are the people we just talked about, the recent investors, okay? And then the purple line, the last purple line right over here, that's the realized price. That's the price of all the Bitcoin and their last movement. You can think about it as the entire economy's average cost basis price of Bitcoin. So you could see a couple of important things. During the 2018-2019 bear market, you could see that the actual price of Bitcoin, the black line, crashes through the true mean price and then also through the realized price. Again, the same thing in 2021-2022 bear market. You can see that in the middle of the bear, it crashed through both of those, okay? So if we take a look right here, this was capitulation. If we look at the blue line, the true mean line, that was 7.5Ks back then. The realized purple line, that was roughly 5,000, and it crashed through. Again, in the next bear market, the FTX bear market, you remember the Luna crash, everything else back in 2022. The true mean price, this blue line, is roughly 30Ks, and then the realized price, when it crashed through, that's the price of all of the Bitcoin, their cost basis of when they last moved. You could see at 22Ks, it crashed through both of them. Now for this cycle, we'll talk about the cycle right over here. So in today's video, we're just going to talk about potential BTC floor price and what happens if it crashes, it goes into the bear market. Then we're going to talk about how the feds are going to melt prices up and what I mean by that. And lastly, an update on Ethereum's Fusaka upgrade. So before we get started, my name is Colin. For those of you who are new around here, what I do is I do fundamental analysis on stock and crypto and their long-term value. Now remember that none of this is financial or investment advice. The markets are incredibly volatile and you risk losing your money. Full disclosure, this is not a sponsored video. Also have nothing to sell you. And then I hold ETH, BTC, and I hold BMNR. For those of you who are on X, give me a follow where I can tweet out this information a lot faster. So with that out of the way, let's get started. So coming back to this chart right over here, you could see that if we were to break through, okay, the true mean, that blue line is what people recently bought at, all the whales, the institution, the DATs, it's actually sitting at 82K. And I agree with Checkmate that it's likely going to crash to somewhere there. So between 80, 82Ks, okay? It might go below it for, a brief moment, 78, 76, but around there. But the true bear market, should it crash through and history repeats itself right over here and right over here in 2018 and 2022 markets, okay? The lowest price that realized or that zombie price is actually at 56Ks. So you may see people talking online about it crashing to 50, 60Ks. But stuff like 30Ks, that's like throwing stuff out there and throwing spaghetti against the wall and hoping that it sticks, okay? So if I had to summarize this, right now BTC is in a much more mature market because as you can see, a lot of institutions have moved in and they're purchasing BTC through the ETFs and other mechanisms. Right now, if the crash would go to 82, that's the new floor price, right? Those are the active investors. And then finally, what they say the absolute price, the zombie price, if it did crash through to the realized price, it would be roughly at 56Ks. So keeping that level in mind going forward, it helps me formulate my investment thesis and where I'm going and what I would be comfortable with just in case BTC drops to these levels. So the other chart, if you haven't seen, it's the whales accumulating right now. So whales own 1,000 BTC or more. You can see right over here, the whales accumulations have shot up dramatically, okay? The number of whales that own 1,000 BTC, or roughly $87 million as of today. You can see right back here in 2024 going into 2025, as Bitcoin was going up, the whales were selling off. You can see right over here, the whales with more than 1,000 Bitcoins, they sold off. And it's been sort of sideways and down right now, but as the price is dropping, the whales are doing the opposite. So it's really reassuring to see smart money or big money accumulate. Now, remember, they're whales for a reason. They got to 1,000 BTC, not by luck, but accumulating probably at a much better time than you and I have. So the other big thing that people were expecting is that QT is ending this week on December 1st. Okay, so quantitative tightening is ending. People are expecting the Feds to inject. Now, I read a couple articles that really got me thinking. This first one right over here by Reuters, Scott Bessent says that there's no recession risk to the economy even after an $11 billion shutdown. Now, you may be thinking, if there's no recession risk, there's no COVID, why is the Feds going to stimulate the economy? Now, the other interesting article that I saw was Ray Dalio was talking about one of, legendary investor Ray Dalio, who's been in the market for a very long time, who has a lot of wisdom in the market, says that if the Feds were to stimulate, they're going to stimulate right into a bubble. So we're going to follow the money trail and see how the Feds are going to be melting up the economy right over here. So first thing is the Fed's plumbing tool. So we talked about this in the past before, QE and QT, quantitative easing, quantitative tightening. We're going to follow the money and we're going to see how they're going to stabilize the liquidity. So quantitative easing, or they talk about balance sheet expansion, buying up securities, all they're talking about is turning on the money printer and starting to inject liquidity again. So for those of you who are new, who haven't been following, that's what they're doing. If you look back at the Fed's balance sheet right over here, I went through this in the past after 2008, the financial crisis, that subprime, that one that Michael Berry shorted. After the whole financial crisis, they did QE1, QE2, QE3, so quantitative easing, pumping liquidity within the markets. If you go back, you can see those dates and you could see them doing QE. The next time they did QE was after COVID, right? We had COVID in 2020, 2021, so they did QE4 right over here, and they pumped up a massive amount of liquidity. By them doing that at the same time, they drove up inflation, they pumped too much liquidity in the market, so what did the Feds have to do? They have to pull back on that liquidity. So you could see that QT started at the end of 2022, and since then they've been tightening that liquidity, sucking out that liquidity from the economy. So doing QT, or quantitative tightening, just means that they're shrinking their balance sheet, they're selling off securities, they're sucking out liquidity from the market. And coming back to this curve, they did it so well that they sucked out $3 trillion of liquidity, drying things up from $9 trillion down to $6 trillion. And if you look at the reverse repo, remember what the reverse repo is? It's the parking lot where banks go to park excess liquidity. So in COVID, when they drove it up with QE, notice they had a lot of liquidity, $2.4 trillion. And then from here on, at 2022 down to here, they lost 99% of that liquidity, going down to about $2 billion, which basically is zero compared to what they had before. That means that banks do not have the liquidity. And right now, because they don't have the liquidity, you can see it on the reverse repo. And then I showed this right over here in the past, the US banks and their reserve. So it was 4.2 trillion in 2021, and it's now 2.9 trillion. And we lost 1.3 trillion along the way. You could see that from James Lavish's work, an ample reserves to the Federal Reserve means that 10% of our US GDP. So the US GDP is 30 trillion right now. 10% of that is 3 trillion. Right now, we're below that line where they would consider there to be ample reserves within the banking liquidity system. And then the standing repo is simply the opposite to the reverse repo. This is when liquidity is tight, banks are out of cash, they'll go to the Feds to borrow from them. So when the usage is up, you know that liquidity is tight. When the usage is down, you know that there's ample liquidity. So right now, putting everything together, you could see what's happening. The Fed started tightening in 2022. They did it too much until up to 2024. They've drained everything out of the system. There's very low liquidity. When that usually happens, the overnight repo rate usually spikes, and that causes a lot of problems for the money market. markets. We saw that in 2019 with the repo crisis, and then also in 2020 as well. This is why the Feds are ending QT starting December 1st. And if we look back to September 17th of 2019, you can see the repo rates overnight spike from a Fed target of 2% all the way up to almost 10%. That's almost a 4 or 5x spike overnight. So it really put the entire financial system at stress, and it froze all of the Fed's plumbing system. So you could see why they would be concerned with liquidity as we start seeing liquidity dry up within the system. So even though we don't have a recession right now, and we don't have a major event like COVID, you could see why the Feds are going to start turning on the printing machine. It's actually to fix their plumbing system. If you take a look right over here, John Williams, who is the president and CEO of the New York Feds, started talking about this in terms of expanding the balance sheet for liquidity needs. That was back in November, okay? And then you can see right over here, the Fed may start buying bonds to manage market liquidity. So the Fed president, the New York Fed president, is indicating that that's what they're doing. But if you look at other people, you could also see Jay Powell, the Fed chair, talking about this in early October. And then you could see right over here, Dallas Fed President Lori Logan. She talked about how the Feds will begin buying assets, again, turning on the printer. Why? To prevent reserves from falling further and maintain an ample supply of reserves. So they're all talking about it. And then Evercore, which is one of the macro firms on Wall Street, talked about this, that the Fed may have to buy $50 billion of asset a month in the first quarter alone. So you could see them all talking about, expanding the balance sheet, buying assets, keeping the liquidity and the reserves ample. So they're actually solving their plumbing system by pumping in new money within the system. So we all know this by now. They're ending QT on December 1st. And what did they all talk about? They talked about expanding balance sheet, doing QE or money printing. Regardless of how they put it at, the end result is always the same. There's going to be more liquidity within the system. What is that going to do? That's going to push risk assets up. So things like stock, Bitcoin, Ethereum, eventually when this liquidity comes back within the market, it's going to start pushing these things up. So I thought this article summarized really well Ray Dalio's perspective and his warning about how our Fed's policy is going to be stimulating the economy right into a bubble. Remember that the S&P is at its all-time high. It's about 1% off of its all-time high. Also, in terms of the Fed's policy right now, we've already gotten 2 rate cuts, and then the one on December 10th, right now the odds are over 86% of another cut coming into December 10th. And then we have 3 more cuts before the new Fed chair takes over from Jerome Powell. Right now, the current runner, is Kevin Hassett. He's the leading person for the job. He's the National Economic Council director, and he's seen to align with President Trump's view. What's President Trump's view right now is that interest rate needs to come down by another couple hundred basis points. So Kevin Hassett said he would be cutting rates right now because the data says so. Also remember that he was the ex-Coinbase advisor as well, so he understands risk asset and where the market is going. So this is what Ray Dalio is talking about when he says we're going to stimulate right into a bubble. Why? Because we're doing a lot of rate cuts. Right now, the market's at its all-time high. We have a deficit. And when the new Fed chair comes in next May, they're going to be pumping even more money into the market, cutting rates, doing QE and money printing. At some point, that becomes unsustainable. We're going to be melting up risk asset price and to a point where we hit a lot of inflation like back in 2022. That's when they slam on the brakes, They stop all of the QE, they stop rate cutting because they ran into inflation, and that's when reality sinks in. So what should you do, right? So this is what the Feds are going to be at, and they're going to be sitting in a room and asking themselves, what did we do to the economy? So what I'm not saying is to sell now. What I'm saying is that risk assets are going to melt up, and the minute that you see the Feds pivot in the future, I think at the end of 2026 or early 2027, likely the end of Q3, Q4 of 2026, when they start running into these issues again, the market has melted up. That's your cue to get out. For those of you who are not in the market right now, that's a great move. Stay out of the market, wait until they go through this entire cycle, and then when risk assets melt up and they slam on the brakes, that's when everything comes back down to reality. So what I'm saying is, it's not selling right now, but it's watching what the Feds do, because they will drive that liquidity. They will drive it into that banana zone, into that parabolic zone before they put a pause onto the market. So my thoughts are right now is that we're still in the bull market. We still haven't seen that parabolic rise, and we haven't seen the Feds pump in that liquidity. Globally, they've started pumping into liquidity slowly, but we're going to see it from the US Feds very soon. So what I've been doing personally, and this is not financial advice, every single time there's been a 20-25% pullback, I buy a little bit more. I buy some Bitcoin, I buy some Ethereum, sometimes I add some BMNR. Now, I'm going to be watching out for all these signals because as we melt up, as we go into that final parabolic phase, if it hits a point or a return that I'm happy with, I will start selling off my position, but not right now because I haven't seen that major move, that major liquidity pump that the Feds are going to be doing to our markets. So finally, let's talk about the Fusaka upcoming upgrade to Ethereum from a non-developer's point of view. So this is just my opinion. So on December 3rd, Fusaka is Ethereum's major upgrade that everybody is expecting. So what I see from Fusaka is that it's going to improve the user experience, the speed of Ethereum, the cost, and the institutional readiness of the entire Ethereum ecosystem. So first thing is ETH is going to feel like it's a consumer product finally. It's fast, it's cheap, and it's easy to use. What I mean by that is that Ethereum is going to have the security grade of what you do with Google and Apple. You can actually sign in, use your user wallet, and you can actually sign all your transaction online with your Face ID or fingerprint ID, and it's going to make it feel like using your native app, your banking app, or something else that you use on your phone every single day. So next thing is speed and cost. They talk about this pure DOS unlocking up to 8 times the data throughput. What that means is it's going to have an instant view, just like tapping on an app on the iPhone or on your Android, and it's going to be instant right away. And the fees on the layer 2, like, based on ARP, it's going to get even better and cheaper. Not that they're not cheap enough already, but it's even going to be better coming up. The other positive thing is that it's going to make it easier for businesses to integrate into Ethereum. The other thing is that it's going to make costs much more reliable, stable, so that businesses can go in knowing that they have that stability and that their operational costs may not fluctuate way too wildly that we've seen in the past. And then finally, I see it as a value accrual for ETH holders. Number one is because it's gotten cheaper for users, but also at the same time, the network is generating more revenue stream. You can see right over here, minimum fee on data usage from L2. ETH is going to consistently being burned over the long term, making it a deflationary model. This really positions ETH as an asset with a monetizable infrastructure that a lot of institutions can get behind. Now, last thing that I saw that I thought was very interesting and I think is very bullish for the market is that Vanguard, the 11 trillion, behemoth, is finally allowing its clients to access Bitcoin through ETF. Now, the last time I saw something major like that was when BlackRock launched its IBIT back in January of 2024. You can see right over here, Vanguard finally allowed them to start buying ETFs. Everybody's been waiting for a very long time for this. I think this unleashes a whole new buying power to Bitcoin, and it's going to be driving up the market. So I hope today gave you some helpful data in order to guide you navigate this market. So if you found those information useful, please consider liking and subscribing to my channel, and I'll see you guys next time.